Good morning. It is Wednesday, October 3rd, and this is the Saxo Bank Morning Call. Some interesting developments. This morning we have the Italian government out sending signals that it expects the deficit, or it hopes for the deficit, or it plans for the deficit to be a bit smaller after this year, down to 2.2% in 2020 and even 2% in 2021. Here with us, our conveniently Italian fixed income analyst, Althea. What are your thoughts on this? I mean, this is interesting signaling. We are seeing a market reaction. Euro Swiss back up a little bit. We have the Italian yields a little bit lower. Is this just a maneuver, or do you think there's enough of the market to actually rally here on this?
I believe that the market will rally on this, of course, because at this point the European Union has to accept this deal that the Italian government is proposing. However, I'm suspecting that these new readings of the budget is just a way for the Italian government to pass through this debt that they want to take, and then next year we are going to go again with the same problem, and we are going to see probably, the parties that still want to implement their policies asking for further debt.
Yeah, I agree. I think this is actually a clever maneuver by the Italian government. I mean, they're saying basically, well, look, we're going to get this budget deficit's going to be larger. It'll encourage growth, and then next year it'll be smaller from a growth perspective. An interesting argument, an interesting tact, and it actually makes the situation, I think, a bit more awkward from the EU side to be too hard on their side on whether they have a 1 year budget deficit. Anyway, we have a chart here of the 10-year reaction and the 2-year reaction in Italian BTPs, the Italian year yields on government debt. And I'll tell you, we did actually go to new highs for the cycle, above 3.25% or so on the 10-year. Never quite got there on a daily closing basis on the 2-year. It looks like the reaction has been a bit stronger in the 2-year. Do you think this is just going to stay sort of in the range here on these yields, or are we going to risk new highs for the cycle if the government or if the market loses faith?
I believe that if the European Commission accepts this budget proposal, obviously, the 2 years yield is going to go back down, and obviously also the 10 years yield are going to go also be below 3%. The big risk, however, this month is going to arrive at the end of October with Moody's reviewing Italy's sovereign rating. So we are expecting a downgrade at this point, and we might see some repricing because of that.
Okay. Sometimes these rating adjustments, though, they're sort of something that's already in the price, if you will.
Yeah, but there has been so much volatility in the past few weeks within the Italian sovereigns that I believe that the market has been focused on headlines rather on expectation of ratings. So that's why probably, after this sell-off, investors are going to look back at what they hold and say, oh, by the way, it's coming also the Moody's downgrade.
Right. Okay, yeah, very headline-driven market for sure, and also driven by headlines is Euro Swiss. We have a chart here where I think it's the Italian yield situation, which has really been frustrating traders that want to go long on the story of European sovereign rates recovering. That's not been the case. You've seen German Bund yields going down a bit. But I think if we break above this, you'll see the two lines on the chart here. 114.40 or so is the low close back in the summer. It was tested once in late August. That's that lower, there's actually three lines here, but the middle line, if you will, if we test above that, then it's up to 115. And I think if we get through that pivot zone, I think there's considerable opportunity for upside in Euro Swiss, assuming a recovering bond yield theme across Europe. If we're able to set new highs for the cycle, especially in the core yields, and start to price in expectations of the ECB finally moving on rates. And that demands that we get over this hurdle of the Italian budget situation over the next month or so. Also, we have here, we have the UK, we have this Tory party conference. Yesterday, Boris Johnson deciding not to challenge May for the leadership of the Conservative Party. This saw a little bit of a relief rally in sterling, but not very impressive. I think there's a bit of a sense that the more dysfunctional the Tories are, maybe the better it is for sterling, because then we get towards some sort of delay to the whole Brexit timeline. In any case, cable is very interesting around the 130 level. I have a chart here where you can see that level very much in play. And there, of course, is the dollar side of this as well, but I think sterling and 130 very key for the outlook here. Theresa May will be speaking later today and trying to put an optimistic face on things. That's a bit of a tall task for Ms. May. And then finally, I've got a chart on Eurodollar and finally on FX, if you will. Eurodollar here, we saw a bit of a bounce. Of course, any further relief in the Italian budget situation leading to lower Italian BTP yields could be supportive for the euro and Eurodollar, and we did not crack that 115 level. That's the lower line you're seeing there. It's really a massive level technically and psychologically for the market. But by the same token, it's going to take a lot of upside here, crawling back towards 117 and higher to get the sense that we're going to realize that upside break again that was sort of falsely signaled by that recent 117.50 attempt in late September. Then we're on to Tesla. The big story overnight with Tesla reporting its production and delivery numbers at the high end of expectations. Interesting to see where this takes the chart. Takes the stock price. We have a 200-day moving average that's been in play in recent sessions around that 316 level. If somebody's going to break it higher, it would seem that the resolution of this SEC situation and these positive production numbers could do so. Certainly, though, the bond market, there's been a lot of focus on Tesla bonds as well, and I'll say you brought an interesting chart today talking about the bond market, and Powell as well, focusing on financial stability. The Fed chairman, financial stability, or at least financial conditions, have almost never, despite all the hikes that are in the bag, have almost never been easy when you look at this option-adjusted high yield spread that we have a chart of today.
Yes, so the reason why I took this chart is just to make the point that I believe that we are witnessing to a U.S. high yield bubble here. And the reason being is that, as you can see, since the financial crisis in 2008 until now, high yield spreads are trading at its tightest. So
this is basically the spread to the U.S. Treasuries. So it's about 310 basis points.
Exactly.
Is what we're seeing here compared to when we had in late 2014 to early 2015. A lot of those energy-related high-yield names up at 800 basis points. So we're all the way back down to 310 basis points. Of course, that's on top of the U.S. sovereign yield, which has gone a little bit higher. But that's very easy financial conditions for corporates.
But this is why it's quite problematic. I believe that this space is quite problematic at the moment because interest rates have been rising. We have seen volatility in the emerging market worlds. We have seen even investment grade spreads widening. However, the high yield U.S. corporate space has been the best performing in the bond market at the moment. So the real question is when is going to be a correction? And I believe that as Powell will continue to rise interest rates, there is going to be more and more pressure on refinancing of deeply high yield corporates, and we might see even a spike in the funds later next year.
Yeah, it's interesting also Powell bringing up in a speech yesterday that he doesn't see inflation being a big problem. One reason the market taking this as not particularly dovish is that we know that Powell's not really worried about inflation. He's more worried about financial stability, and that goes along the lines of the junk bond market. So as long as these spreads are going lower, Powell is going to continue to hike.
Exactly.
Right. Okay, so that brings us to our calendar slide for today. We've got a lot on the table here. All of the ISM non-manufacturing survey in the U.S. and then all the services survey across Europe and in the U.K. Watch out for those. Could see a bit of reactivity as well. ADP payrolls change. Not as much focus on that as there will be on Friday's average hourly earnings number after that high print for the cycle for the August numbers. And then do look out for, of course, we have Fed speakers, Powell speaking again. I don't think we're going to see much new spin versus what we saw yesterday. And Prime Minister May, how does sterling take that? And then we have the rest of the week. China still closed. Big question marks on the Chinese currency and what the plans are from the Chinese regime there. And over the weekend, that Brazilian election, a big hurdle for EM. We have two populists, so a right populist versus a left populist. Very uncertain what the second round scenario is, and very uncertain whether either of those populist candidates will do anything that is needed to address the serious pension and fiscal deficit situation in Brazil. So Brazil has sort of sat out a lot of this. It's rallied some, the Brazilian real, but it sat out a lot of this recovery in emerging markets. That's it for us today. We'll be back tomorrow with the Saxo Bank Morning Call. Thanks.